Hello. The observation that modern money moves the world is an inescapable fact of life. As money, or rather currency, has value, it is readily digitalized and falls prey to those who use the manipulative power of mathematics. The question posed in this series is whether, given that our entire international order revolves around digital currencies, we are using the right mathematical tools to manage them. So this is the first video in a series looking objectively at the tools, or rather equations, that we use to measure and manipulate money. As a disclaimer, I should perhaps first mention that my academic trajectory was in biophysics and biochemistry rather than economics, although, during my time at Cambridge, my interest in econometrics was piqued by the debacle of Britain's embarrassing and costly departure from the European exchange rate mechanism, an event which effectively shipwrecked monetary integration and ultimately led to Brexit. How was it, I wondered, that a country that spawned the great Maynard Keynes could have been so spectacularly wrong and spent tens of billions unsuccessfully trying to extricate itself from this financial fiasco? The utility of economists, if not their actual function, is of course to predict the future, an invaluable function if investment and risk avoidance are the business of governments and investors. However, as I'm sure that most of you have noticed, economists seldom agree on anything and are like meteorologists, trying to fit precise mathematical relationships to immensely complex and multifactorial nonlinear phenomena. One of my favorite definitions of an economist is someone who, when you request a telephone number, simply gives you an estimate. Humor aside, the relationship between variables and finite factors, such as the number of bars of refined gold, or the number of automobiles rolling off a production line, is anything but static and everything but irrelevant. In an advanced industrial society, where modern conveniences are, to many, the very purpose of their existence, the precise pricing, supply, and quality of such goods and the cost of running them in terms of energy and maintenance are far from minor considerations. From a position of basic logic, the more any household, company, or government spends on energy, the less it has to spend on other goods and services. However, if we define economics as being our attempts to define the patterns of human interactions with our collective resources and fellow humans, our efforts have proven to be at best guesswork and at worst fallacious fiction. Recent events have put many cornerstones of economic theory under the spotlight, and this channel will re-evaluate how reliable, or indeed accurate, many of the mathematical laws of econometrics are. You may well be asking the very fair question of why a former biophysicist should be casting his opinions, analysis, or aspersions on the world of economics at all. Well, in the first instance, economics and physiology are kindred disciplines in the sense that if you ask a physiologist what the effect of caffeine might be on blood pressure and heart rate, the physiologist might reasonably respond, based on empirical measurements, that both will be increased. If you were then to ask what the precise increase in blood pressure change would be, say, after 3 strong cups of coffee, the physiologist could only reasonably respond, well, that depends on a number of factors. Many might sagely suggest that I have no qualifications or business wading into this field. In this regard, I can only refer them to Mind Bomb, a book in which I made many prescient predictions, including the global financial crisis of 2007 and 8, the rise in the retirement age to 70, the London riots and the failures in Afghanistan, amongst others, based on an analysis of historical data and the extrapolation of prevailing trends. Perhaps then there is merit in this approach, a thought path which has been proven successful where so many marquee economists were proved spectacularly wrong. So, using this logic, in this series I will revisit many cornerstones of current economics and ask whether some of these mathematical metrics are actually helpful or even accurate. In this first video, we will examine the question of gross domestic product, or GDP, and whether our increasing reliance on this metric is ill-founded. GDP is one of the most universally recognized terms in economics. Most people will be able to tell you that GDP is a generalized measure of how large an economy is, even though they might not be able to tell you how it's calculated. To economists, GDP serves as a measure of production within an economy. The overarching idea is, the more that is spent, sold, and invested, the wealthier an economy is deemed to be. One of the warning signs of GDP as a metric is that it is naturally a sum of the individual parts of the economy, although the whole is often more than the simple sum of its components. GDP is given by adding private consumption, private sector investment, government spending, and the balance of trade, or exports minus imports, abbreviated to NX. Put into simpler terms, GDP equals C plus I plus G plus NX. The easiest way to approach this is perhaps to break this into constituent terms and see just what is included and what is not. The first term, consumer spending, or C, contributes the largest component of GDP as it is a driver of the manufacture of goods and the provision of services and, therefore, serves as the primary motivator for investment in factories, the construction of malls and ports, the flow of capital and net migration. This is the parameter governments target when they want to create a fiscal stimulus or rein in inflation. However, this also both includes and hides private consumer spending funded by borrowing or credit, which is not genuinely a consequence of healthy economic growth in the form of real disposable income after taxation. To put this into perspective, private debt in the United Kingdom stood at 187% of GDP in 2021, or over £1.8 trillion at the end of October 2022. Thus, incorporating credit card spending within GDP figures can be considered, to use a biological metaphor, as being essentially anaerobic activity, as it will all have to be paid back in theory with aggregate interest. Some macroeconomists also consider this metric to be misleading. For instance, Say's law of markets argues that private savings and production are more important than aggregate consumption as a driver of economic growth and activity. It also understandably excludes sales of goods and services within the black or shadow UK market, which we will term U, an informal cash economy that may amount to over £150 billion, according to some estimates, although its accuracy may of course be challenged. A third problem is that the same sale can be counted on multiple occasions. For instance, if a factory sells an electric battery to a car manufacturer, the cost of the same battery is replicated within an assembled car, and again if the car is rented out or if there is any additional refurbishment or maintenance. So, further sales accrue from the same battery without increasing the number of units produced. However, we can rationally replace consumer spending, C, with the net sales of all sectors within the domestic economy. Net spending, or NS, is given by sales plus U minus aggregate consumer borrowing, or ACB, plus gross interest, or GI. Thus, NS equals S plus U minus ACB plus GI. This brings us to the second term, I, or gross private investment, which serves as an indicator of the future productive capacity of the economy. However, there are several issues with this factor. First, investments in manufacturing capacity or infrastructure may take many years, or even decades to materialize in the case of major infrastructure developments, and so these are hardly relevant to a snapshot measurement of the health of the actual economy. Second, while venture capital may be considered an actual boost to prevailing national wealth, especially if it comes from outside the UK economy, debt funding is again a red herring, as it neither adds to current wealth, nor does it avoid adding a further drag on the economy in the form of debt repayments and interest. Third, any investment of existing domestic private national wealth in future capacity clearly does not represent a net gain in prosperity for the national economy in the short run. Thus, we can exclude I as a valid term and more confidently replace it with the inflow of foreign wealth, or foreign direct investment, commonly abbreviated to FDI. This brings us to the value of G, or government spending. Government spending of course derives from its aggregate taxation revenues, which include all manner of hooks and traps, some of which siphon off a proportion of revenues, while others address actual forms of wealth such as property, death, and capital gains on investments. So, we could justifiably perceive tax to be a proportion of national wealth, and its expenditure within the economy as a valid measure of economic activity. However, a great proportion of government borrowing, or GB, is deficit spending, which saps wealth from the country in the form of bond repayments and compound interest, and so we might argue that G might be better expressed as net government spending, or NGS, which is given by G minus GB plus interest. This leaves us with the one credible parameter used in the calculation of GDP, which is the value of net exports, or NX. This tells us a great deal about the competitive health of an economy, as it is the sum of the exports of goods and services minus imports, a figure which represents the net outflow of wealth from the economy. While this is relatively easy to monitor, it does however omit the smuggling of contraband goods and services and the human capital, or HC, that underpins all innovation, manufacturing, and services. HC is largely factored to take into account corporate earnings, which are represented in the form of tax, sales, and employee earnings after tax. HC can best be measured as the aggregate net income of all workers after tax, as we have already included taxation revenues within the parameter for government spending. Last but not least, we need to factor in invisible earnings from supply chains operating in foreign markets that generate profits for companies that are headquartered within an economy. For instance, a freight shipping firm's cargo ships may seldom visit their home ports, yet their overseas revenues may be substantial, and old money from past investments still reaps rich dividends and income streams. Banks and insurance companies also reap billions from overseas markets. These are collectively referred to as invisible earnings, or net foreign income, which we will abbreviate to NFI. So, rather than simply adopting the rather comfortable standpoint of being a critic, we can offer a more realistic, rational, and readily reckoned measurement of an economy, one which we can term gross economic activity, or GEA. As delineated above, GEA equals NS plus FDI plus NGS plus NX plus HC plus NFI. Calculating the GEA for the UK for 2021 from official statistics gives a GEA of around £1.3 trillion, a figure that is far lower than the official £2.2 trillion estimate for GDP. The GEA is itself an undeniably generous metric, as it also attempts to factor in the black market, invisible overseas earnings, and aggregate household earnings after tax. Thus, if there is one legitimate criticism of GEA which can be levied, it is that it errs on the optimistic side. As for GDP, it is a wildly over-optimistic metric and should be consigned to history. So, perhaps GEA might serve as an interim standard indicator until something better comes along. So next time you are told that an economy grew by 0.1% in the final quarter, thereby technically staving off a recession, you can treat such a claim with healthy skepticism. Please feel free to debate in the comments section below.